The path from mortgage pre-approval to home ownership is filled with landmines. Step on one of them and you may just blow up your entire deal. I'm Jill Taylor. Welcome to Authority, our newest segment on The Wire. Joining us today is Domenic Postorivo, Senior Loan Officer with Green Tree Mortgage. Welcome to the show, Domenic.
Thank you, Jill.
As professional real estate agents, Doug and I counsel all of our clients that a mortgage pre-approval must be in place before they begin shopping for a home. Dom, can you tell the audience the importance of a mortgage pre-approval?
Sure. The mortgage pre-approval shows the seller that the buyer is serious and able to put an offer in on the home.
Now, what does the process entail?
It's really simple. It takes about a 10-minute phone conversation where we're going to ask for bank accounts. We're going to ask how much money they have in the bank, W-2s, tax returns, and also where they're getting their down payment money from.
And all of this information is used in the actual mortgage application once they select a home.
Correct.
And this buyer's mortgage pre-approval is physically submitted with every offer that a buyer makes.
So basically, once they give me everything verbally, I just back everything up with hard copies. So we'll collect tax returns, pay stubs, bank accounts, we put them in a file, and they actually the loan gets processed, and then it gets ready to get submitted for underwriting.
Many clients mistakenly believe once they've given you all of this information, that's their end of their reporting obligations, their financial obligations, and they're good to go. But being professionals, we realize that's not always the case. There's quite a few landmines and things that can go wrong getting to that actual mortgage and the settlement table. Can you give us a few examples?
Sure. Very simply, over the next 30 to 45 days is what it takes to typically go through a mortgage process. We're going to look at every financial thing they do, any account that they open, anything they close, anything they buy. All their accounts will be verified, and we'll keep getting new bank accounts and keep getting pay stubs throughout the whole process.
Okay. How important is continual employment in the same job?
Very, very important. If you don't have, if you basically lose your job or quit or get fired during the process, typically you're out of luck. You're not getting a mortgage.
What about somebody that's just looking to do a lateral move?
A lateral move, they're typically going to want you there for at least 30 days, and they're going to want probably 2 pay stubs from you.
So if you're in the buying process of a home, it's something that you really need to think about, figure out if you want to buy the home first or change your career.
Correct.
Okay. And how about major purchases? Many times we get a buyer, they're so excited, they put an offer in, it was just accepted. First thing they do is they run out and they buy a new couch, a new refrigerator. They say, okay, Home Depot, we're opening up this new line of credit.
They're all no-nos, Jill. They're all no-nos. Buying a car, buying a boat. Buying a car is the worst thing you possibly do when you buy a home. What it does, it really affects your debt-to-income ratio. Having a $400 car payment may not seem like that much, but it could take between $80,000 to $100,000 buying power away from the buyer.
Okay, and leasing a car, would that be the same thing?
Same exact process, yes, same thing.
What about opening up another credit account?
Open up another credit account could actually make your score go down at that point.
Even though somebody's saying that you're able to qualify for more money, what if you don't put anything on the charge account, you don't run it up, you just open it?
Doesn't matter. Still open an account will still negatively impact your score.
And co-signing, a lot of people, they're moving, they have college kids trying to build their credit, so they're co-signing for their children.
I see that they want to help their kids, and it's great, but it really affects the way you qualify and how much you can qualify.
Okay. What about existing accounts that aren't being utilized? Oftentimes we have clients that say, wow, I have this amount of credit out here outstanding, but I don't want to use it. I'm just going to shut down this complete account right now.
That's a no-no, Joe. That's a no-no. Closing any accounts, what happens is it seems like the prudent thing to do is to shut them down, and you're going to make your new mortgage payment and live happily ever after. When you shut your accounts down, it gets reported to the credit bureau. At that time, they think that they were shut down by the creditor and not by yourself voluntarily.
So it could have been something that the buyer was negligent in.
Correct.
What about if you explain that and you just say, oh, this is why it happened? Is it a too late scenario?
You're too late. It's going to probably take anywhere from 30 to 90 days just to get through to somebody to get the process going, and you're probably going to be denied on your loan at that point if your credit score was hovering the limit where we need to be.
And so many of these mortgage products have strict cutoffs that your debt to income have to be within these levels. Are they all the same for every mortgage product?
No, Joe. Actually, there's 3 major products. There's USDA, There's government loans which are actually let you have a little higher debt to income and give you a forgiving credit score. Where a conventional loan, they have lower debt to income ratios, and they typically want a higher FICO score.
And there's differences too on whether you have mortgage insurance payments based on how much money you put down. All of these factors a buyer has to consider. So that's where the importance of a mortgage professional comes in guiding them.
Right, so when I first start, the first thing I typically do is take all the information and I run your credit. And when I run your credit, that puts me in a spot where what program I want to put you in at that point. If you have a high credit score, if you have a low credit score, there's different programs for each individual at that point.
What if a client comes to you and they say, I have decent credit, but I have this lien or this judgment against me. Should I take care of it now and pay it off? What would you advise them to do?
Okay, so when you have a lien or judgment, what happens is it shows up on your credit. It could be there for 3, 4, 5 years at a time, where it still affects your score. That lien or judgment will have to be paid off before you actually close on your new home. But I would suggest you not to pay it off before you talk to a mortgage advisor. At that point, the underwriter will probably want it paid off at closing. At the closing table, if it gets paid, at that point, it won't affect your score. It won't have a negative impact on you getting qualified for your mortgage.
So that would be a condition for the property to actually settle.
Correct.
And does it matter if this is a $50 lien against them or a $5,000 lien? Is there less of an impact if it's a smaller amount?
A lien is a lien, a judgment's a judgment. No matter what it is, they still need to be paid. They'll have the same impact.
Wow, so a lot of people actually think, oh, that was a medical bill, I forgot to pay, it was $25, but that can't impact them the same amount. How long can it take for their credit to improve once it's been dinged?
Typically, once it gets paid off or once it gets dinged?
Once it gets paid off.
Okay, once it gets paid off, it takes between 30 and 120 days. Once you pay it off, you'll take an initial credit hit where you'll drop maybe 20, 30, 40 points. At that point, after 30, 40 days, your credit will start to swing higher.
So all of this planning really needs to be done 6 to 12 months before a buyer starts to decide they're purchasing a new home.
Absolutely. If someone's looking to buy a home and they're not really sure if they're ready yet, it's a great time to talk to a mortgage advisor now to get everything, all their ducks in line, so when they're ready to buy, they're able to.
Thanks, Dom. Great takeaways. If you like what you saw today and you're watching on YouTube, be sure to hit the subscribe button so you don't miss a single episode. On Facebook, remember to comment, like, and share. Why, Dom?
Because real estate's more than buildings, lands, and property.
It's about the people in the communities where they live, work, and play. Until next time, I'm Jill.
I'm Dom.
Thanks for watching.
Thank you.
AC, bang, rock the house, pow. Come on, help me turn it out. I'm MD, bang, and I rock the house, yeah. You know I'm gonna turn it out, young.